Well, the ball has dropped. It is 2026, and now we want to know, what is the market going to do in 2026? What is our economy going to look like in 2026? What's going to happen with interest rates in 2026? In this episode of Wealth on the Move, the podcast, I sit down with Chief Investment Strategist from Motley Fool, Bill Mann, and we talk about just that. Make sure you check out this episode of Wealth on the Move, the podcast. Your life journey doesn't stand still, and neither should your wealth. Welcome to Wealth on the Move, the podcast. All right, we are back. Welcome to another episode of Wealth on the Move, the podcast. I'm your host, founder, and president of Hoffman Wealth Management. And today, I guess we're doing our obligatory annual outlook for 2026. Every firm has one. Every firm does them. Every asset manager, every bank, every mutual fund company, and Hoffman Wealth Management is no different. So today we have a special guest from Motley Fool Asset Management. We have their Chief Investment Strategist, Bill Mann. So first, Bill, welcome to the Wealth on the Move, the podcast.
Have you ever heard the story of, first of all, hi. Good to see you, Will.
Great to have you, man. Thanks for being here.
I'm really glad to be here. You can tell I'm a little bit excited, just ready to start talking about subject
Love
number
the
one.
energy. Love it.
A couple of years ago, Jamie Dimon took the chair of the CEO Council, and he went back. And every year, the CEOs of America's largest businesses do this survey. And he did something that had never been done before. And he went back and he looked at their predictions from past years.
Okay.
And you would think that CEOs of America's largest businesses have a pretty good idea, because whether we like to think about it this way or not, they've got inside information.
Sure.
And their predictions, Jamie Dimon found, were awful in terms of what the next year was going to be. So I'm always mindful going into these exercises.
It's one of those things where I understand why they do them. The Aztecs really did us a disservice with the calendar in some opinions, because the market doesn't know that the ball drops, and our pocketbooks and our household budgets don't know that the ball dropped. Our 401k contributions don't know that the ball dropped. But January 1st, there's going to be millions of people leaving Times Square after the ball drops, and they're going to want to know, what does 2026 look like? And that's what we're here to try to talk to them about, because, listen, the folks who listen to this, they're not CEOs of the world's largest. Actually, I hope they are. And if you are, please let us know that you're listening. Please share it with all your friends. If you'd love to jump on and be a guest, that'd be great. But they're not hedge fund managers. They're busy professionals. They're active retirees. They have kids. They have mortgages. They have 401ks. They check their 401 or their portfolios on their phones between meetings and kids' lacrosse matches and soccer games and on their lunch breaks. And they want to know, what in the world does 2026 look like? So before we get too deep into the weeds here, give me the 30-second download on Bill Mann and Motley Fool Asset Management for our listeners, so we can familiarize ourselves with you guys.
So I'm the founding chief investment officer of Motley Fool Asset Management. We've actually been in business since 2008. And Motley Fool Asset Management started as a side of desk for the Motley Fool Publishing Company, which is our sister company, which is where I got my start with the Motley Fool on the publishing side. And essentially in the early 2000s, when we saw people get really, really hurt during the .com crash, we had a conversation about what it is that we can try to do for individual investors to give them a place where they can go if and when they panic. If a market environment comes up again, what is it that we can do for very, very smart investors, very savvy investors who still, during periods of great stress, want a port in the storm? And so Motley Fool Asset Management was that for a really long time. It was kind of a side of desk for the publishing company. But about 6 years ago, we saw the shift from mutual funds to ETFs, and we are an all ETF shop now. We used to be mutual funds. We were the first company to transition an actively managed mutual fund into an ETF structure.
Okay.
And we realized that there was that we had missed something very basic, which is the Motley Fool has always been all about talking to individual investors. And we realized that wealth managers are all about talking to individual investors as well. So in making the move to ETFs, we also made a change in how we were doing our business, which was very basically, let's have conversations with the people who are already having these conversations with individual investors, and let's see in combination if we can really help people make better financial decisions.
Yes, and as a student of this industry for 23 years now, and an active participant in this profession, I'm very familiar with Motley Fool. Have been reading all of your stuff since it's become available. I think my mentor even turned me on to you guys. But I do have one question that has never been answered. How did you guys come up with the title Motley Fool?
So the founders, Tom and David Gardner, were Shakespearean scholars. And
Okay.
so they really wanted to have something that was differentiated. And we started basically with a newsletter, and then we ended up on the AOL platform. And the Motley Fool, they were thinking about names like, hey, let's call it Money Liking, or and so they just really couldn't come up with something that seemed all that differentiated. So they went to their educational background, and the fool was the person in it, not just Shakespearean lore, but it exists in Japan, exists in China, exists in India. There was a character who was the fool who could tell the truth to the king and not lose their head because of it. And so said, well, why don't we adopt that as our ethos? The people who are truth tellers, who are here to help people make better decisions with, under their own interests, and, just tell a little
Gotcha.
truth about
Now
what
it makes
was. Yeah,
sense.
yeah, there you go.
No, because your logo is the court jester's hat who is telling the truth to the king while with no risk. So now it
Yeah.
makes all the sense in the world. Okay, before we get into 2026, one of my favorite lines from any sports commentary that I've ever seen, in 2017, Shalane Flanagan was on her way to be the first woman in a really long time, first U.S. woman in a really long time to win the New York City Marathon, and the commentators were noting that she had not looked back over her shoulder once. And the one commentator said something, and I say it to my kids all the time. And he says, why would she look back? Nothing you want is behind you. But let's look back at 2025 for a second.
So we're not going to listen to that advice, right?
So we're not going to listen to that advice. But if for your kids listening, don't look backwards. There's nothing you want is behind you except for this quick part of this conversation. Let's look back at 2025. What surprised you? What was expected? We know we went through a pretty rocky spring with Liberation Day and the tariffs. But what did we learn from 2025 when it's related to market cycles?
Well, when you think about 2025, I think because of the Trump administration's policies, I mean, it really represented a paradigm shift from the 40 years before that. If you think about what the previous 40 years have been like, it has been more and more and more presumption that the world's economies were going to integrate for the betterment of all participants. So the Trump administration and their policies turned that on their head. They basically have said that China has not become, it has not become a partner in a lot, for a lot of reasons. And we have essentially outsourced a lot of things, some good, some bad, to China. So the Trump administration came in and they had three real policy goals. The first of which was they want lower gas prices. They want the lower dollar, and they wanted interest rates to be lower. And they have actually achieved those three things. Those three things have all happened.
Right.
And if you think about, if you think about an environment in which you are trying to strand assets, essentially we are looking, buy it through tariffs, which I was actually somewhat surprised that they went through and as aggressively as they have. A tariff environment is one that's inherently deflationary, because you are seeking to upend an existing paradigm, and in doing so, you're going to strand a ton of assets. So what happens when you strand assets is the assets themselves and their owners don't just don't just roll over. They do whatever they can do to remain
Sure.
competitive. So I think that what we have seen in 2025, and this is a story that's far from done, and I'm sure a lot of your listeners right now heard me say the word that tariffs were deflationary. They're like, "Hey, pal, have you stepped outside? Have you pulled your wallet out?" Like, but that is what they are. So I would say at the beginning of 2025, even though at that time we knew that Donald Trump had won the presidency, that so many of their policy goals would have been enacted as aggressively as they were.
Okay. So there we have it. Done looking backwards. Now,
Yeah, thank you.
major indices right now. We are at 48,000 on the Dow. We are at 6,800 on the S&P 500. We're at 23,000 on the NASDAQ. Where do we go from here when it comes to just the major indices right now and 2026?
So if you look at the S&P 500, I'm going to dodge this question a little bit, but I'll try and circle back around because the answer is ultimately and ought to be I don't know.
Sure.
But if you think about where we are with the S&P 500, we are as concentrated within a single industry as we have ever been in technology, and we are as concentrated as we have ever been for the 10 largest companies, which are almost across the board technology companies.
Right.
I think Eli Lilly, sneaks in and Berkshire Hathaway sneak in. So, sneak in at $1 trillion market cap. But there you go. So if you ask people what their greatest worry is in terms of the market, a lot of people will say it's that concentration. So there's only two ways for that concentration to get solved, just mathematically. The first of which is the Magnificent Seven have to drop. The second of which is that the other 493 companies have to grow faster than the Magnificent Seven. Right. So at some point there is an equilibrium. So if you ask me what the market is going to do in 2026, I would suggest that it will probably end up somewhere close to where it is right now, but the internals of it will be different. I think that there are areas of value that are so far disconnected from the AI build out, from the $250 billion in spending that we're seeing in that part of the market. But ultimately, the problem in terms of saying a raw number is that it's all being driven by AI spending at the top end.
Okay. So a broadening out is on your horizon of those other 493 and companies that aren't even listed on that index.
That's right. I think it has to happen. I mean, just mathematically, so much money. If you look at what did best in 2025, in 2025, I think we could say right now was an interesting year for the markets, but it was a good year for the markets. They have gone up. But the areas that have gone up the most were companies that have no revenues, and then the Magnificent Seven. And everything else within that barbell have not done all that well.
Okay.
And I think that they are reflective of an economy that is kind of doing the same thing we saw with interest rate cuts recently. There's broad disagreement, even within the Federal Reserve and the Fed governors, what direction and what it is that they need to be focusing on most. So it's always a tough question, but I think it's specifically hard this year.
Sure. And you bring up a great segue to my next question, the interest rate environment and how the Federal Reserve is positioning us. Your thoughts there. Should they have been lowering rates? Should they continue to lower rates? Do you see that stalling out? What is what do you think's happening there?
Well, the super exciting part about this last Fed governors meeting, and there were lots of really super exciting parts, but maybe the most super exciting part is that it came right on the back end of a government shutdown. So they didn't have the same amount of data that they usually have. They literally have skipped,
they skipped October, right?
They skipped October. Well, the economy didn't skip October. We were doing stuff.
Right.
That's right.
Or did they just skip telling us about October? Right?
That's right. October, I do actually remember as existing.
Right.
So if you think about the two primary focuses for the Federal Reserve, the first of which is employment rates,
Right.
and the second of which is market stability and inflation. I think that what is happening, and again, when you think about how the U.S. economy and also manifested by the markets has concentrated in only a few different industries, that middle America is in a very, very different place than the financial markets are.
Yes,
And
I would agree.
I think that what happened at this Fed meeting, which is why you had people like Austin Goolsbee going, "Let's make it a 50 basis point cut." And you had other Fed governors saying, "We want zero cuts," and they landed on 25. Is it different Fed governors are focusing on different things, and right now we have this bifurcated economy where you've got a lot of it that's really struggling, and we know this anecdotally, and we know this from the statistics that are available. But then you also have wild amounts of spending in AI. You have asset appreciation that across the board, housing prices, the stock market, and then you also have a pretty healthy amount of affluent retail spending.
Right.
And those are the three stools that legs of the stool that I think the US economy is dependent on right now. So when you look at the Federal Reserve and their decision making, I think that they said, well, this time we need to stop worrying about inflation and we need to worry about employment because some of the internals there are really, really concerning.
Okay. Yeah, there was an article, I don't know if it was last week or 2 weeks ago, about the number of planned layoffs
Yeah.
that were kind of concerning, approaching financial crisis, or I'm sorry, COVID crisis type levels.
Yeah,
Um,
I saw that as well. It was the highest number of layoffs and planned layoffs in a calendar year in history. It's like 1.1 million.
yes,
So that's 1.1 million jobs. Like not
sure.
to not to make an obvious point, but those are people,
You're right.
and those are people who are in an environment like So my kids, I have two kids who are just out of college, and watching some of their incredibly talented, incredibly smart college friends put out 5, 6, 700 resumes and
Ugh.
not get a single call for an interview, like that is really, really concerning.
Yes. Yeah. Because you're right. Those are dinner table conversations. Those are 401k contributions.
Hmm.
A mentor of mine said, whenever you're learning about this process and learning about people when it comes to wealth management, you're always dealing with a nervous system first.
Yeah,
And
yeah,
those are folks are nervous.
yeah.
They're concerned because, like you, they're seeing their kids struggle. So are we prepared for that? How do we prepare for that when it comes to our portfolios? Is that a result? I mean, the questions around that are innumerable. Is this because of AI? Is AI a good thing? Is We're going to get into that here in a second. But I guess how do when we're sitting around our kitchen table, how do we prepare for 1.1 million planned layoffs or layoffs and planned layoffs and that prognosis? Because a 25 basis point interest rate cut is I mean that's not going to help, right?
Not right away.
Right.
I mean, if you think about the economy in general, it is and has always been a confidence game.
Hmm.
Right. And I happen to think that the administration is exactly right about this. How do you give confidence? Well, one way that you could do it is make money a little bit cheaper.
All right.
But that's maybe that's overstating it by a lot, but
Sure.
I don't think that that's an unreasonable way to think.
So
AI.
how do we sharpen our portfolios? Does a shift need to come from in de-risking a little bit? Is that the path? I mean, if especially if we're looking at a flat market, we know that bond portfolios seem to have a pretty healthy response to interest rate reductions.
Yeah, not to talk my book too much, but we
Sure.
did just release three new ETFs. One of which is a value-driven ETF, and it's based on the research of our sister company, the Motley Fool. And the other one is a momentum ETF, which is designed to capture those changes in market sentiment in a way that is, where we are not taking predictions; we're just taking what the market is telling us. It is, I am very loath to tell people ever to take their assumptions and move too far away from the S&P 500. I
Right.
think that the S&P 500 itself is a fantastically diversified internal money making machine.
Yes, and it's our best hedge against inflation over the long term.
Exactly. Yeah.
Right.
Thank you. Yeah, exactly right. What is the single best way to, to keep yourself from really being impacted from an asset basis on inflation? Well, one of them is to own the companies that are raising prices.
Right.
So, and again, all
And
of
paying
the
dividends. I mean, you have a lot of
yeah,
dividend payers in the S&P 500. That's
yeah, yeah. And we'll see in a lower interest rate environment whether that comes back a little bit, but but we do have substantial income opportunities within the S&P 500 now. So I'm sorry, I have spaced what the question was. I
that's all
answered what
right.
I wanted to
What
answer, and
we were talking about what we want our portfolios to look like in 2026. I think, I mean, I think our opinions aren't too far off with, the S&P 500 being a great basis for inflation hedge, a great diversification metric. I call myself a permable. Maybe
Mhm.
2026 doesn't look great, but when we're standing here in 2036 or 2046, we're not going to be unhappy that we were invested alongside of the S&P 500.
And that's ultimately it. I mean, it's the ethos of the Motley Fool and Motley Fool Asset Management for being long-term investors that you have to be willing to give up periods of underperformance. Like you
Yes.
just like if you are a long-term investor, one of the things that you have to be able to do is give yourself the awareness that there are periods in time when the choices that you make aren't going to feel that great.
Right.
Right.
Risk is
That's
risk
how it
is the
is.
toll for the market highway, right?
Right. Right. And if you think of something, if one of the ways that we like to think is giving yourself a risk budget. And the
Right.
risk budget works basically this way. I could remain in these companies that I know are some of the best companies in the world. And they are cash flow, they are cash flowing, they're growing, everything else that are at, a valuation that makes me a little bit nervous.
Right.
Or I could move to what are lower quality companies that are cheaper. In each case, you're taking something from that risk budget,
Right.
and if you make that move, what you have to hope is that you're right about the valuation, and you're right about and you're wrong about the quality of the companies that you're moving to on the upside.
Okay.
Right? Like
So
if I think that they're lower quality, what I really need to hope for is that they're higher quality than I think.
then I think so,
Yeah.
right? Or that everybody wants to buy lower quality stuff at some point, and
Exactly. And I happen to think that this is the case with the market right now, and why when we have a fairly bifurcated economy, that there are a lot of companies that are, that are in like basic materials, and that are somewhat cheap now.
yeah.
And so if you are looking to make some moves, I would start looking into industries that that the market has forgotten, and look for some of the highest quality companies within those markets.
Okay. Thank you for tuning in to this episode of Wealth on the Move, the podcast, brought to you by Hoffman Wealth Management. Here at Hoffman Wealth Management, we focus on working with busy families and active retirees, helping them navigate the complicated scenarios of their wealth while building the life that they desire. And we believe that every financial journey deserves direction. That is exactly what our proprietary process, the HWM navigation formula, provides. Just like a GPS, our navigation formula begins with two key questions. Where are you now? What does your financial picture currently look like? And where do you want to go? What goals and dreams do you have? From there, we help you navigate every financial turn en route to your desired destination with clarity and confidence. It's more than a plan, it's a personalized path forward. If you want to learn more on how the navigation formula can work for you, reach out through the contact options in the show notes below. We would love to help you chart your next move. Now, back to this episode of Wealth on the Move, the podcast. Let's move on to some geopolitical considerations. And the article you shared with me that I read about kind of your assessment on Europe. and they're filled with, would you say, farms and museums?
Factories and
Factories and
museums.
museums.
Yeah.
Factories and museums. Great article, great insight about why the United States is seems to be the economy that most folks prefer to take risk in.
Yeah.
How do you see things happening with, this tariff fallout, our relationships with economies around the globe, their relationships with us? How do you see this shaking out further in 2026?
The U.S.-China relationship, I think, is obviously, is obviously the most interesting one, and I
Mhm.
think that the move that we saw this past week, where President Trump and the administration, did an about face and is allowing China to buy very very high end chipsets. That is a sign to me that they did not quite see the move that China was going to make, which was to limit our access to rare earths. So
Okay.
that is a relationship that I think that we're going to continue to see, to see real tension, and I'm not really sure where it's going to land. A lot of people tend to look at the Chinese economy and say, well, they own such a huge amount of U.S. treasuries that they have control over us.
Sure.
The balance sheet in China is somewhat awful,
Okay.
right? They are structurally massively indebted, in debt. And they're in debt in a very specific way, not at the central bank of China, but at the local government basis, because the local governments and the local jurisdictions don't have tax raising authority. The only
Okay.
way that they can raise money, the primary way that they could raise money, is by selling off their land bank. So when you see companies like Vanke in China, which is a development company,
Right.
that has $50 billion worth of debt that they're in default of, that is a real risk internally within China, because they are one of the primary ways that the local jurisdictions raise money.
Okay.
That's what they, so what they have. So that that market and that environment is going to continue to be very very fluid. But China does not have, the they 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 don't have the Uno card in their, in their deck
Right.
necessarily. Like, they're not throwing draw four on, on the United States necessarily. Although it's it is an environment where we're dealing with
Does
someone.
anybody have that Uno? Like, do we have that card? Does the U.S. have that same card? I mean, it's kind of like a
We've got a draw two card, but we played it in the form of tariffs,
right.
right? Like, if you think about what those tariffs are, in general, is that they are a demand that there is a reordering of global trade. Like, we are going to force this.
Okay.
And if you think about the places that have the highest tariffs in the world, they're places like Cambodia and Myanmar. And the reason why it is there and not China itself is that the U.S. government is saying, China, there's no place for you to hide. You can't send goods to Cambodia, put a sticker on them, and declare them as made in Cambodia goods.
Right.
So that is our trump card. It's not a great one, but it's not a bad one. I mean,
Sure.
it's not for nothing that almost every country in the world ended up playing ball, because the U.S. domestic consumer is the driver of the global economy.
Yes.
So anybody who wants, any country that wants to grow really on some level, needs access to that,
Right. Yes.
to that rocket fuel. So we do have one a little bit. So that's Asia. Europe is just another beast entirely. And,
Sure. Yeah.
and a lot of people probably don't recognize this, because we come from a history of Americans on a lot of levels really, really looking up to Europe. Whatever, it's in the American psyche when, when someone says, well, the Europeans do things differently. In some ways you're like, oh, that hurts a little.
Right.
Right? Like, oh, they're fancier than we are, right? Like,
So they do things differently except grow. But
yeah, exactly. And one of the things I'd written about in my article is that Europe, and they actually recognize this, that they really need to hit a reset button on their economy. And
Hmm.
last year, they put out a competitiveness report for the EU, and it came back and basically said we're not competitive under any circumstances under the current policy decisions that we've made. But whether they have the wherewithal and frankly the sufficient political braveness to change, I think is a much deeper question. Germany, which is the engine of the European economy, has a GDP per capita that's lower than every U.S. state except for Mississippi.
Yeah. So I posed that question to our staff here in our team, and they were blown away because you would think, I mean, look how small Rhode Island is. Just
Yes.
just size alone should dictate that Germany's doing better than Rhode Island or
Yeah.
Delaware or the Dakotas, because there's so much open space, and they're not.
They're not. Yeah, the state that really blows my mind is Arkansas.
Yeah.
What do we think of when we think of Arkansas? We
Walmart.
do not. We do.
Walmart and Whitewater. That's it.
Thank you. Yes, we do not think economic vitality. Like
Right.
that's just not. And for anyone who's on here from Arkansas, I love your state. I'm not talking crap about you, but it is not an economically. It is not one of the states that you would think of right away as being, oh, it's an economic powerhouse,
Right.
and yet they have a higher GDP per capita than
Than
Germany
Germany. Yeah.
does. It's wild to me.
What about anything emerging market wise? I know that's kind of falling by the wayside right now because development and the AI conversation here.
Yeah. Yeah. So there are exciting economies. I think Brazil and
Hmm.
Korea in particular. Somehow Korea is still classified as an emerging market. That feels like cheating to me. Say, oh yeah, Korea, but the Brazilian market, it just in terms of the raw materials that are going to be required, Brazil has that. They have in Brazil a I guess I would describe a surprisingly robust banking regulatory authority, and so there are banks within Brazil that are somewhat interesting to me and are priced somewhat low. I have found in the banking sector that some of the greatest banks that I have found are the ones that are located in emerging markets, but then have cost of funds that are several percentage points below all of their competitors, which just simply means that you've got a bank that has a local reputation that they can lend money out cheaper than everybody else because everybody trusts them.
Yeah. Well, and that's where the riskiest growth potential exists. And if they're lending it cheaper, they have the bigger upside.
They have the bigger up, yeah, exactly, and it's almost like a cheat code, right?
Yeah.
If you've got the lowest cost of funds in a market that is somewhat closed, and so you're getting a 200 basis point advantage, call it, over everybody around you. You have to have done something right. I mean, to
Yeah.
me, it's almost like one of the greatest sign points for a good management in the financial space when you've got something that just seems like that's an outlier like that.
Yeah. All right. So the topic that really drove the markets in 2025, that's going to, in my opinion, continue to drive the markets. It is almost as popular as Taylor Swift and Travis Kelce getting engaged. But I want to talk about AI and AI adoption. I remember the internet boom in the late 90s. I was in
Mhm.
college then, and it was fun to watch and be around because every day there was a new website, a new internet tool. I have to imagine that this was kind of like the gold rush in California, where not just the people finding gold were getting wealthy, but the folks selling picks and
Mhm.
transportation and housing and everything around that. AI and its adoption. What inning are we in this AI game? Let's start there. Are we in the third inning, or are we starting to round the bend here towards later adoption?
I think we're in the third inning, but
Okay.
to beat a baseball analogy half to death, it is May, and so there are thunderclouds, and so there
Sure.
may be a rain delay.
Okay. So, AI has led anything affiliated with AI. We've seen utilities run up significantly because
Yeah,
of the data center growth. We've seen companies. I know our firm is one that has become way more efficient by using and utilizing AI for some things that hasn't replaced anybody. It's made us better at our careers, made us better at our professions, made us better financial advisors, and helped us deliver things in a much quicker and much deeper way. What's left? It's so exciting to think about what's left if we're only in the third inning. Yes,
yeah,
there's probably a rain delay. Listen, there's going to come a time when NVIDIA misses earnings. It's going to
yeah.
happen, and that's going to um, roil the markets, like you've said. Those top seven have led, and there's two things that happen: the other 493 broaden out, or the top seven, falter a bit. That's going to happen at some point. Is it in 2026 or is it in 2030? Who knows? But where are we with AI and adoption? Where do you see this AI stuff going in the next year or two?
I mean, obviously, I think that we are already in the midst of a great reshuffling of jobs that are in demand. And when you have a reshuffling,
Yes.
and I use that term very specifically because I think people are focused on jobs disappearing. And they
Hmm.
should. And we already talked about
But they
1.1
always
million
have.
layoffs.
I mean,
Yes,
how many people did Henry Ford put out of work with the assembly line?
exactly. No, that's exactly it. The jobs that are coming, not necessarily because people are super immersed in AI, because those are the ones that come first.
Right.
That happened with the internet, as well. That happened with, road building for Henry Ford,
Right.
car building as well. There will be a reshuffling of jobs, and there will be a re-imaging of a lot of the jobs that we think of now that are going to be enhanced by AI, and they're going to be created by AI. I firmly believe that.
Okay.
Um, the
Give me
issue
an
for
example of that. A job created by AI.
Well, I mean, I think that we see, I think that we see now, for example, medical research, and cancer research, and being enhanced by research that pulls in so many different aspects that that AI is able,
Yeah.
to do something that a single researcher cannot do. But
Okay.
as we know from AI, and nobody can see me here, but I've got some gray hair. I'm of a certain
Well,
age
this
in
will hit
which
YouTube, so yeah, they will be able to see.
they'll see. I think a lot of people tended to think of AI as being, like a Google replacement, and it's not.
Okay.
What AI is a research enhancer, but it will only give you what you put in.
Right.
So there already is, and there will continue to be a huge knowledge base that develops on how do I properly use this tool?
Hmm.
How do I properly create queries, layer them on top of each other? There will be an art form that comes from the human judgment that comes from this tool. I
Okay.
really firmly believe
Yeah,
that
I
that's the
think. I mean,
case.
firms are going to be looking for AI experts to hire to say, how do we use this to make this firm better, to make this company better? And there's going to be folks that have those skills that can create the prompts
Yeah.
that we didn't even think of.
Yeah. Just last week I watched a video, and this is going to tell just exactly what level of geekiness I am. And it was the World Championships for Excel spreadsheets.
Okay, you know what? I'm glad to
Are
know
you
that I'm not alone. That
are you with me here?
I didn't watch them. I didn't pop some popcorn and grab a beer and watch them, but I did know that they happened
That's right.
because I mean, to me, Excel's always been a great decision helper. It
Yeah.
helps make so many decisions for
Yes.
us.
And Excel has been around at this point in some form, going back to Lotus 1, 2, 3,
Right.
for 40 years. Right. And so you have people And they obviously have, a lot of them have an accounting background. They have facility with numbers, but you have this tool that is available to anyone. Who There are certain people for whom it's really, really they know how to use it better than anyone else,
Yeah.
and it's a tool that could have and should have eliminated the green eye shade business entirely, but it's
Yeah.
the tool, right? So
And it's one of my favorite Instagram accounts to follow is an account that is just constantly posting prompts to
yeah,
use, and to take their prompts and customize them for our business or my family or our situation. It's incredible the learning mechanism that AI can be, even if it's, and it's not replacing anybody. It's just broadening my knowledge. It's
right,
making me a better financial advisor, understanding the psychological triggers that our clients have that I didn't even realize existed, but now I have a way to ask and get answers that relate to wealth management to make myself a better financial advisor.
precisely
And
it. Yeah,
it's to I'm excited. I mean, I'm always excited about looking forward. I'm really excited about what this can do. I don't fear a war with robots yet. Um,
that's what
you
they
know,
want you to believe,
that's what they
Will.
want us to think, whoever they is or they are. But yeah, I'm not worried about going to war against robots yet. Maybe I should be, but again, I'm excited about what AI can do. It's a constant thing that I encourage our team to use and to scrub our
hmm
own ideas and scrub our processes with.
Yeah,
All
you
right,
did.
looking. Go ahead. I'm sorry.
I was going to say, you did ask me about about what's coming, and I think that there is an area in which there is that there is a real fear, or that I have a fear, and that is the fact that we've spent this much money. I mean, someone
Right.
has spent billions and billions of dollars. Most of it has been equity based, but some of it has been debt based, and in both of those cases, those investments and those investors want a payback. They
Right.
want a payback that comes on that comes on a cycle. And I think one of the areas when I talk about the rain delay is the fact that in this country, a single activist can use our laws to delay massive infrastructure programs.
Right.
Like, we are the United States. It costs more to build infrastructure here than any other country in the world. And it comes not just from the permitting process, but because everyone in this country has standing to sue to
Right.
stop projects.
Right.
You can
Well,
just do it.
I mean, you're right in the heart of data center alley
Oh,
with
yeah.
with
Yeah.
with where you are right now, and we know we don't have enough.
Yeah.
And
We're Northern Virginia. We're trying.
right. So as we're looking at 2026, and I'm not going to ask you to pick some stocks, but I want you to give me characteristics of companies that we should be picking, or characteristics of sectors that we or asset classes that we should be leaning into when it comes to constructing our portfolios.
Yeah, I think that there are plenty of pick and shovel type companies.
Okay.
One of the areas that I'm most interested in actually are, and this is going to sound really really dumb. There are very few companies that grow the trees that are useful for making utility poles.
Okay. And we're going to need
I,
more of those.
We need more.
Yeah.
We need so many more of them. And here's the thing about trees, Bill. Well, I don't know if you know this, but you can't just plant one and harvest
Right.
it tomorrow. Right?
What is it? The best
So,
tree was the one planted 25 years ago or today. That's it.
yeah, that's the list.
Okay.
There are certain bottlenecks, and in power production, in consulting for power grids, things like this, where you look at the spending that is going to come, and you say, I am willing to bet that the bill that they have is 2-3 times X what the book is at this,
Okay.
at this moment. Actually, excuse me, the reverse of those two things. Never trust a dyslexic to get a formula right. the book is several times what they're billing right now.
Okay.
And and there are a lot of companies like that, and they aren't necessarily doing things that are going to be disruptable. You like even Nvidia has competitors out there that that could disrupt it.
Sure.
It's
I
really hard.
remember,
Yep.
I mean, vividly sitting in class in the late 90s, early 2000s, um, trying to imagine who was going to do things better than Walmart.
Yeah.
They had so much leverage when it came to pricing. Who was going to be able to do this better? And along comes Amazon, and here we are. And now I'm sure they're sitting in those same classes saying, "Who's going to do this better than Amazon?"
Yeah. The
And
crazy thing about that, and you're exactly right, is that worked out okay for Walmart too.
sure, right, yeah,
Yeah, I always love those constructions where you say, well, who's going to disrupt X?
hmm
The first thing you ought to be doing is looking really hard at investing in X,
right,
whatever it is, right? And Walmart, Microsoft, companies like that, they took a long time to find their footing, but they had, they had it in place.
right. Well, and that competition makes us all better
Yeah,
at a certain point.
yeah, that's right.
So they're called black swans for a reason because we don't see them coming. But what kind of black swan possibilities do you see, if any, ahead of 2026?
I'm gonna call it a charcoal gray swan because
Okay,
everybody sees this, but it would
okay,
be China actually invading Taiwan.
okay,
That would
and that
be
would have implications on our markets. I
that
mean,
would
it's
have
going to have
implications on
it's everywhere. Yeah.
everywhere,
Okay.
including China. It would be an economic disaster within China, but that's that's the one.
Okay.
And I think I think there's actually a very low probability of it happening, if for nothing else, because China Taiwan is a very useful thing for China to have as a perpetual problem. Whenever
Yeah.
there are issues within the country, they can always, you know, saber rattle at Taiwan. If you
And
fix that
rally them.
problem,
Yeah.
yeah, if you fix that problem, then you've taken an arrow out of your quiver.
Okay.
But that's the one.
So what are some specific actions right now that folks can take for 2026 that you see would they'd be happy they did come this time next year?
I think one of the biggest things the biggest thing that you could do is, as we started at the top with, is nothing.
Right.
But if you are, if it is something that is worrying to you, to have a market that is very concentrated, I would take a look at not necessarily statistical value strategies, because to me, statistical value at this point, you're talking about companies that don't necessarily have much in the way of growth in front of them, but looking for strategies where you're focusing on higher quality companies that have not necessarily caught the bid within the overall market. And we have strategies in Motley Fool Asset Management that do that exact thing. We're very proud of them, but that is my primary advice to people, is to recognize that the S&P 500 is, for good reason, more concentrated than it has been at any point in our lifetimes. And that's something that, at some point is going to get solved one way or another.
Okay. All right, some lightning rounds for some quick predictions. So next year we jump on the call at the same time. What do you think is going to be our biggest surprise in
What do I think is going to
2026?
be our biggest surprise? I think that we are going to look at the Japanese market, and it is going to be one of the best performers in the world.
Interesting. Okay. Finally again, right?
Yeah.
Yeah,
Been a
it's
while.
been
Yeah.
yeah. Um, what's one, I'm not going to say stock because we don't want to be stock pickers here. What's one sector that we should be watching very closely right now, for better or worse?
Shipping.
Okay.
Shipping at every level, because they are in the middle of the resort, along with reshoring and and the interests and the policy goals of the current administration.
Okay. And last one, best piece of advice that you can give anybody heading into 2026.
Start looking towards 2027. The best piece of advice that I can give is to read and to breathe, and really, internally, and this is something that is, I think, somewhat timeless. Take a look at this period of time. It's almost end of December, and take a look at your portfolio and see if there are strangers in it, and see if there are companies that make you nervous. Because there's no reason for an investor to be truly nervous about anything within their portfolio. And now's a good time from a tax basis that you can make those moves. Make them now and feel good going into 2026 that that your portfolio expresses what you believe.
Okay, so and then this question is more for me. Other than Bill Mann, who should we be following or listening to or reading on a regular basis to get practical market and practical investment information?
So two of the best in the business, the first of which is Howard Marks.
Okay.
And he puts out a letter. He put one out very recently. They are his company is a distressed investment company. And so they pay much more close attention to the credit side of the portfolio, but credit actually drives the markets, not the stock market.
Right.
And the other of which is my good friend Morgan Housel. He's just come out with a new book, and it is sensational. I was quoted in his first book, so I like to tell people that I co-wrote it with him. I don't know that he loves
the opening quote of that book, when it comes to personal finance, to me should be plastered on every one of my peers' office walls, when it says, your experience with money represents 0.0000001% of all the financial transactions ever in the world, but it's 80% of how you think of money reacts.
Yeah.
And it's so true. We all get stuck in this, our own kenosphere of well, that's how money works.
Yeah.
And that's not. And it's,
absolutely,
nobody's thinking the same way when it comes to that. And that opening, it's just one line of text on one page at the opening of his book says so much.
He could have written a pamphlet.
Yes, that was
it. or an epitaph. I don't know.
I want to get him on this show so badly. He's I haven't read the second book, The Art of Spending, yet, but great just mechanisms for thinking about money.
Yeah.
And your approach to money beyond picking stocks or setting a budget and things is so timely and so important. Bill, how can our listeners follow you and follow more of what you're writing and putting out every day?
So I do have a monthly newsletter. I have a newsletter at mfamfunds.com. It's called Man on the Street, under Insights. True to a monthly newsletter, it comes out monthly.
Okay.
The next one comes out on the 15th of December. So
which is today. We're recording this December 15th, right?
There you go. So that's how you can find me. I'm on Twitter at TMF Otter. You get more sports commentary than anything else from me there. That's about it.
All right. So make sure you follow. And again, you can follow us at any of our Hoffman Wealth Management pages on Instagram. I'm very active on LinkedIn under Will Hoffman AIF. You can always check out our website. That's the best way to get in touch with us with any other questions at hoffmanwealth.com. But until next time, please remember, keep your wealth moving.
Bill Mann and Motley Fool Asset Management are not affiliated with Hoffman Wealth Management and Private Advisor Group.
Will Hoffman offers investment advice through Private Advisor Group, which is a federally registered investment advisor. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult with the appropriate qualified professional prior to making a decision.